There are many ways to calculate a company's cost of equity. Here, we'll use the most popular one, the Capital Asset Pricing Model, also known as CAPM. The model was introduced in the 1960s of the previous century, but remains relevant to this day and age. The Capital Asset Pricing Model suggests that a company's cost of equity is equal to the risk-free rate plus beta multiplied by the market risk premium. When it is applied in a capital budgeting context, we have to be careful and consider parameters that are relevant to the project. We have to apply a risk-free rate, a beta, and a market risk premium, which are project-specific. Okay, perhaps we're getting a little ahead of ourselves. Let's explain in more detail what each of the parameters means. The risk-free rate in an economy is the rate of return that an investor would expect from a financial security that contains zero default risk. The investor buys the security and can be absolutely certain that he will be repaid on time and in full. Of course, in the complicated world of today, very few securities, if any, can be considered risk-free, but most practitioners use the yield of a 10-year government bond in order to approximate this measure. The rationale behind using a 10-year and not a 3-month bond is that the valuation of the firm is a multi-year exercise, and hence the risk-free rate that is used shouldn't reflect a period as short as 3 months. Right. In our driver's sheet, we have 2 risk-free rates, one deriving from a bond security issued by the Italian government and one deriving from a bond security issued by the Vietnamese government. Which one should we use? The project is in Vietnam, right? Therefore, we'll use the Vietnamese risk-free rate. The next component in the calculation is beta. This is a statistical measure. For those of you who love statistics and quant finance, beta can be calculated with the following formula. And it is basically used in order to show how a financial security behaves with respect to the rest of the market. That is why we are dividing its covariance with the rest of the market by its variance. If this is a bit confusing, don't worry. There are many financial providers who calculate a company's beta for you. Let's open P&G's Yahoo Finance profile. As promised, you can immediately see the company's beta. Here it is. A beta that is less than 1 indicates that the stock is less volatile than the market. A beta of 1 shows that the stock is as volatile as the market. If the market gains 1%, it will also gain 1%. If the market loses 5%, it will lose 5% as well. Stocks that have a beta that is higher than 1 are considered aggressive and are more volatile than the market. If the market grows 2%, the respective stock will probably earn 2.5 or 3%. You get it, right? A company's beta will typically have a value ranging between 0 and 2. In our driver's sheet, we can see that the company's beta is 0.9. But this is the entire firm's beta, and this can be misleading. A preferable practice is to calculate a project-specific beta, reflecting the actual market conditions of doing business in Vietnam. This is why our team provided us a list of comparable companies performing the same activity in Vietnam. We have their leverage and beta. So, what needs to be done is calculate the average leverage and the average beta of the 3 companies, and then adjust the average beta obtained according to the leverage of our project. How can we do this? Well, we need to use the formula for unlevered beta, which has been done here. To calculate unlevered beta, which is the beta of a company with no debt on its balance sheet, we have to divide the average beta of comparable companies we have here by 1 plus 1 minus the tax rate times the average leverage of comparable companies. See? This gives us unlevered beta, a beta which disregards financial leverage. And the trick now is to relever beta with the project's leverage. That's easily done. All we have to do is use the formula for relevered beta, which you see here. This is how we obtain the project beta for all years of the forecast period. The final variable we need in order to calculate the cost of equity is market risk premium. This is the extra returns investors in a given market require in order to invest in equity and bear additional risk. It has been proven empirically that the average market risk premium investors require varies between 4.5 and 6.5% in different economies. In our case, we'll apply the market risk premium in Vietnam because this is where the project is going to be realized, and hence we'll use a market risk premium of 6%. Okay, great. Now we have everything we need. Cost of equity is given by the risk-free rate plus beta times the market risk premium. Of course, nothing's in the way of calculating WACC too. The percentage of debt financing has to be multiplied by the cost of debt of the project multiplied by 1 minus the tax rate. This then needs to be summed, the percentage of equity financing times the cost of equity. Voila! It wasn't so difficult, was it? Awesome! Let's keep our momentum in the next lesson, where we'll start discounting cash flows.